This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Investor Connect is a 501c3 nonprofit dedicated to the education of investors and startups for fundraising. Please consider donating $100 to the program to help others in their investor and entrepreneur journey. You can find the donate button on the investorconnect.org website. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Michelle Seiler Tucker, founder and CEO of Seiler Tucker Incorporated and host of the Exit Rich podcast. Michelle's company helps business owners with evaluations of their businesses so they can sell for the most profit and find the right buyers for them. The Exit Rich podcast is dedicated to helping entrepreneurs retire rich and exit for the price that they've always dreamed of and deserve. Michelle, thank you for having me on your show and thank you for joining us.
Thank you. Thanks for having me on.
Well, great. So where are you calling from today?
I'm in New Orleans.
Well, great. Well, tell us a bit about your background and how you got to where you are today.
Sure. So it's a 30-minute show, so I'll make it very quick. I'm an entrepreneur. I've always been an entrepreneur. I started out, owning my own businesses. I did end up going to work for Xerox for a brief time where I was a high volume manager and then was promoted to regional vice president over the South. Realized I didn't like working for corporate America, so I stayed in entrepreneurship. I started my own franchise development, franchise sales, and franchise consulting company where I was equity partner with some franchisors and really grew their business and put them on the map using other people's money. And then I transitioned from franchise sales, franchise development into mergers and acquisitions nearly 22 years ago. And been selling businesses ever since. So we specialize in buying, selling, fixing, growing. I partner with business owners whose business I find to be very interesting. I have a niche. They need my help. So I'll partner investing my money, my resources, my energy to get their business where it needs to be so we can exit for millions of dollars down the road. We also help business owners get their business ready for sale in what I call the Exit Rich program. Or it's a monthly program for a year, and we're really focusing on the business, getting the owners working on it, not in it, and building the proper infrastructure, what we call the 6 Ps. And we sell businesses, buy businesses, flip businesses. So that's our core competencies.
Well, great. Well, our audience are investors investing in startups and startups who are raising money from investors so they can grow a business to sell it. Everybody wants to get to that point. It sounds like you're the person they need to talk to before they sell the business. What do you think is the biggest mistake startups make when they go to sell their business?
Well, lots of mistakes. Number one, if anybody reads my book, Exit Rich, it's endorsed by Steve Forbes. And Steve Forbes says 80% of businesses on the market will never sell. M&A Source says 90% of businesses on the market will never sell. So if you want, if you don't want to have less than a 10 to 20% chance of survival and selling your company and exiting rich, then you really have to plan for that. And the reason why so many people don't sell their business is because they don't think about selling. They don't think about it until a catastrophic event occurs, whether that's internal or external. Internal could be health issues, partners disputes, divorce, death. External could be this pandemic that we're living in. The worst time to sell your business is during a catastrophic event. You should plan for your exit. I call this in my book, Exit Rich, the GPS exit model. And that's where in our book, Exit Rich, we really teach our business owners how to start with the end in mind. Like Stephen Covey always says, start with the end in mind. Figure out what your destination is, that sales price, what's your business worth today, where you're starting from. So you want to know where you're going. You want to know where you're starting from. And then you want to know, what is your time frame? And then you want to know who your buyers are, where your revenues need to end up, etc. That's called the GPS exit model. Because the biggest reason businesses don't sell is because business owners haven't thought about it, haven't planned their exit. And when they do decide to sell, they call me up with a crazy number like, I want to sell for $20 million and their EBITDA is $100,000. So if you want to sell for $20 million, build a $20 million business. But in fact, most business owners, most entrepreneurs have created themselves a glorified job that they go to work at every day versus a business that actually works for them. So if you want to sell a $10 million, $15, $20 million company, you need to build a company and not a job. And so that's the other reason businesses don't sell, is because business owners haven't thought about their exit. They haven't planned for their exit. People don't plan to fail. They fail to plan. And most importantly, they haven't built their business on the proper infrastructure of what we call the 6Ps, the Seiler-Tucker 6P method.
Great. Well, we see a lot of startups raising funding, and we always get into the discussion of valuations. And in the early days, we end up with a lot of what I call funny money calculations about what a business may be worth. We don't sell it right now, so we can put whatever number on it that we can get other people to buy into. But when you go to sell the business, the funny money game ends and now the real world begins. And can you tell us a little bit about setting valuations when you go to sell the business? What do you look for?
Yeah, so we look for a lot of things. And, if you've ever watched Shark Tank, which I'm sure you have, a lot of business owners get booted from the stage. They get kicked off the stage because they simply don't know their numbers and they don't know what their business should be. They don't know their evaluation. And everybody, thinks their baby is so pretty. So it's my job and a shark's job to tell them that their business is not as pretty as they think it is. So we look at a lot of things, and it depends upon the industry. If it's a SaaS industry, it's typically always a multiple of revenues. If it's any other industry, it's a multiple of EBITDA. But that's where the 6Ps come in. So we evaluate all businesses on the 6Ps. The more infrastructure they have in place, the more the business can run without them, the more proprietary assets, etc. I'll take you through it real quick. People, you got to ask yourself, can this business run without you? Are you working in it or on it? Can you leave for a month? Can you leave for 2 to 3 months? And the business will run fine without you. That is what I call the true test of an entrepreneur, is how long can you leave your business and your business doesn't tank? And do you have a management team in place? Do you have the non-competes? Do you have the contracts? Do you have the employee handbooks? Do you have the right people in the right seats? Have you asked the who question? Who handles legal, accounting, manufacturing, distribution, quality control? The list goes on and on. And then buyers will discount. So this is the loaded question when we start getting the evaluations home, because buyers will start to discount. Like we're selling an app company right now, and it's run by husband and wife out of their home. Well, the buyers gave me an offer and they deducted $500,000 from infrastructure because there are no people, there is no corporate office. There's nothing really other than cash flow and users on the app. And so you really got to look at every aspect of that company. So first is the people. And then the second thing is the product. Is your industry in a thriving or dying industry? If your industry is in retail brick and mortar, you're probably not going to get the highest multiple for that business because it's in a dying industry. If you're in the restaurant industry, restaurants have still not recovered fully. So you're probably not going to get the best multiple. You also got to look at, like we were selling a furniture store that catered to the hospitality industry during the pandemic. Well, you know what happened during the hospitality industry? It completely shut down. So even though the business, was doing okay, their customer wasn't doing okay. Their client, so they had all of their revenue, I would say 80% of the revenue was tied up in hospitality, and they had a 20% in a different vertical. So we really had to discount for that. And so did the lenders, because nobody knew when hospitality was coming back. And so when you're looking at product is your service, your industry, your products. You got to look at, is it on the way up and you got an Amazon? That's when you sell. And if you got an Amazon, then you get a higher multiple. But if you're on the way out and you have a Blockbuster and you're about to go bust like they did, then you're not going to get much for your business. Same thing with processes. If your processes aren't efficient, if you don't have SOPs, standard operating procedures for each department, if you don't have all your ducks in a row, then your business isn't going to sell for as much, because buyers will come in and they'll discount what it will take for them to come in and implement all those processes from the beginning. Same thing with proprietary. It's a long answer, so stop me whenever you want.
No, it's a great answer. There's a lot of elements that go into it. I deal with a lot of startups where we all talk about revenue, and it's just about revenue. But revenue is really not the only factor that really goes into
revenue is hardly never the factor. So I don't know what kind of startups you're working on, but revenue is a factor for SaaS companies.
Mm-hmm.
Revenue is not a factor for most other industries. It's based upon EBITDA, because a company can make $50 million, but yet lose $10 million every year. So why is somebody going to pay a multiple of that 50 million? But for SaaS companies are always about revenue. So that's the problem is a lot of business owners focus, and we're skipping through some P's, but a lot of business owners will focus on the revenues and not focus on the profits. Who cares about the revenue? Yes, you want to have revenue, but you want to make sure that business is generating a profit. Otherwise, most buyers will never touch it.
Okay. So what do you think is the biggest myth that startups have when they come to you to sell their business? Is it the revenue profit thing, or is it something else?
Well, I'm sorry. What is the biggest what?
Myth. The mistake they're making is they come in the door wanting to sell their business.
Oh, they got so many of them. That's a 10-hour show. But let's go back to evaluation because we haven't fully answered that one.
Okay.
And I think this is very important for your listeners. So we talked about people, product, processes. Next is proprietary. So proprietary, this is why I want to get back to proprietary because I need your listeners to understand this. Proprietary is the number one value driver. The number one value driver. So let's say the more well-branded you are, as long as your brand is relevant to the mind of the consumer, the higher we're going to sell your business for. Now, if you have a Toys R Us, nobody is going to pay any money for you, right? Because you're not really relevant anymore. Blockbuster's not relevant anymore. But Apple is. Apple's brand alone is worth $289 billion just for the brand. And then we look at trademarks. Do you have any trademarks in place? Do you have any patents? Patents drive value. Trademarks drive value. Contracts in place, especially if you got federal trademarks. Contracts in place. State, local contracts doesn't really do you any good. It's the federal contracts federal trademarks you have to get. And then do you have contracts with your vendors, your manufacturers, your clients? Do you have a recurring subscription model? A recurring subscription model will add value. Will add a higher multiple? Do you have proprietary software? Do you have a database? Can it be repurposed? Can it be retargeted? Does that database, Facebook paid $19 billion for WhatsApp, and WhatsApp was hemorrhaging money. And they were about to go under. And then do you have celebrity cachet? We're selling a business right now. It's got all these celebrities that buy their products. So they have huge branding. They are preeminent in their industry. They have huge cachet, and they have really proprietary vendor relationships. So all of this stuff drives value. If you've got a celebrity like Oprah Winfrey endorsing your products, that company is so much more valuable with her than without her. And strategic buyers, there's 5 different types of buyers. Strategists and competitors will pay a lot more money because they want their products in front of the queen of everything. And then you got patrons. If you've got customer concentration, most businesses follow the 80-20 rule. 80% of your revenue comes from 20% of your clients. If you have customer concentration over 30%, you're in trouble. You're in trouble when you go to sell your business. And buyers will look at that. They want a discount for that, and they want to mitigate their risk. So we got a business we're selling right now for $55 million. They have 75% customer concentration. And, I had to kiss a lot of frogs to get the prince of the buyer to buy this company. And so then you've got profits, and profits is what we were talking about earlier, that people focus on revenues. Look, lack of profits is not your problem. Lack of profits is the symptom of not operating on the other 5 Ps. If you have the right people in the right seats, you got a good management team in place, the business can run without you, got your processes buttoned up, you're in a thriving industry, and you got all your proprietary assets, you're going to be profitable. It's almost foolproof.
Well, great. Well, I always tell startups, when you get to the part of valuation, you're negotiating. It's a negotiation process, not a formula. And when you sell the business, how much can be impacted by negotiating with the buyer versus it's really a formula? They're just going to set it and you get what you get.
No, it's all negotiations. I mean, they have formulas, and it depends again who's your buyers. If it's private equity groups, they got certain formulas because they're not buying on emotions. They're buying on pure finance. Do the numbers make sense? Is it logical? If you got a sophisticated strategic or competitive buyer, sometimes they're buying more on emotion because like, oh my gosh, if I can buy this business and I can get that contract, then I can catapult my business to the next level. The other thing that I didn't mention in evaluations is the synergies. Now, this is so important. People will pay more for the right synergies that will catapult their business to the next level. Private equities don't really care about that, but strategics do. competitors do. And I'll give you an example. We're selling an oil manufacturing business, and we had about 150 buyers. We had 12 LOIs. They all came with different contingencies to the deal because they wanted to mitigate their risk. The seller operated on all 6 Ps except for patrons. They had customer concentration. So that 65% of the revenue was tied up in BP, and all the buyers were worried. Well, if you lose BP, there goes 65% of your business. But I found a strategic buyer that has similar products and services, but was not a competitor. And they've been trying to get in BP for 2 decades and could never get in the door. So guess what they did? They said, oh, well, I'll bet everybody else. So they paid 165% more for that company than what the company was appraised for because they wanted BP. We have another client, the manufacturing company. That manufacturing company had a $5 million distribution facility. And the buyer has manufacturing, has distribution centers all over the United States. First thing the buyer's going to cut is $5 million. So just like I said earlier, they'll deduct things because you don't have the infrastructure, you don't have the people, you don't have the processes in place. They also will add to the EBITDA because if they can cut a distribution center or something like that because of synergies, then they'll add to that EBITDA. So they increase their revenues by $5 million, just like shutting down that one facility. And they moved all their people to other facilities that they needed help in.
Great. One question I always ask my guests is, what online information source do you find most helpful in your work?
Oh, I can't give away all my secrets.
Maybe just one of them? Then just one?
I'll give you one. Let's see. We use so many. One of the biggest things we use is Google, believe it or not. So there's a shout out to Google again. But we use Google a lot. But we have 3 different proprietary systems where we can pull information, just on contact information, like people's names, companies. Then we have softwares where we can tell what deals have taken place. What was the EBITDA? What was the revenues of that transaction? How long did it take? So we've got probably 6 different software systems that we use to gather all the data. But just, I would say we use Slack, we use Google, and of course we use Zoom.
Great. Well, that's very helpful. And so you have a podcast show as well. Can you tell us a little bit about it for the audience so they know it? And why do you think it works so well?
Why my podcast works so well?
Mm-hmm.
So my podcast is Exit Rich. And, I think the reason it works so well is because business owners sometimes feel lost. They feel like, oh my gosh, who do I go to? Where do I go to get marketing? Where do I go for tax strategies? Where do I go to maybe find an integrator to integrate all my visions? Where do I go, for legal strategy? Where do I go to find a good staffing agency or a good recruiter? Or how do I, build my business to exit? How did other people do it? And how do other people have 7 and 8, 9, exits, billion-dollar exits? And all that information is on Exit Rich. And so we've interviewed the founder of Constant Contact, who sold his business for millions. We've interviewed, and that's Alex Stern. We've interviewed Jeff Hoffman, who was a founder of the airport kiosk and also one of the founders of Priceline. We've interviewed, Dr. Nito Cobain, who is a college professor at High Point University, and he also is on the board for Lazy Boy. I think it's Pandera, Great Harvest Bread Company, one of those bread companies, and a bunch of other companies. And so you're really getting firsthand knowledge about how companies started from the ground up and how they built their huge empire and they were able to exit rich, plus all the tips and strategies and resources that you need in between to grow a sustainable, scalable, and sellable business for your desired price tag.
That's great. Well, in the last 2 minutes that we have here, what else should we cover that we haven't?
Well, we haven't covered where they should get my book and where they can reach out to me. But the big thing I'll say is that every business owner, like I said, it can be lonely sometimes to be a business owner because who are you talking to? Your employees? Sometimes you don't want to go home and talk to your spouse. My husband tells me don't bring work at home. Sometimes it's hard to find people to talk to. Not only that, but business owners are so used to making mistakes and learning from their own mistakes. Why not learn from other people's mistakes? why not really go out there and get yourself a great mentor where you'll learn from their mistakes, and not just any mentor, but somebody specializes in your particular industry or your particular craft. And it'll shorten the learning curve dramatically. I always say it's hard to read the label from the inside of the bottle. You need an outsider's perspective to read the warning signs and keep you out of the danger zones.
Great. So where do they find your book?
So my book is still in Hudson bookstores. It was on a round table. Now it's on the shelves. And the Barnes & Noble, all the major bookstores, Amazon, of course, our website, exitrichbook.com. The audio version came out in June. So if you prefer to listen than read, then you can get the audio version on Audible, Amazon, iTunes, wherever you buy your favorite book. And then everybody can reach out to me at seilertucker.com, or I'll make it really easy, STI@360.com.
Well, great. Well, appreciate your sharing that contact details. That was my last question. I want to thank you for joining us today and hope to have you back for a follow-up soon.
Thank you.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.